Welcome to our webinar for today, the balance of ancillary services pricing and outlook. We're just going to give it a couple more minutes for to let other folks join us. I'll be back in a couple of minutes to get us started. Okay, well, we have an action-packed agenda, so I thought I would get us kicked off. I think there'll be some more people joining along the way. So today, we are going to be talking about ancillary services, both the demand, supply, pricing trends, as well as our analysis of the outlook for demand for ancillary services over the period of 2050. And then we'll finish with summary and takeaways and recommendations, as well as vote on the next power session. Um, the webinar is being recorded and it will be distributed to all registrants along with the presentation. And I should mention that the presentation's got a lot of material in it, and I'll probably be touching over a number of the slides so I can spend more time at the end. Please add your questions to the chat along the way. There'll be a Q&A session at the end of this. And my colleague Sarah, she'll be monitoring and curating that along the way. Please also don't forget to vote for what you think should be the topic of our next webinar in August. All right, without further ado, so let's kick off with just a quick summary of ancillary services. What are they? How are they specified? And what are some of the emerging ancillary services products that we've identified through our research? Now, I'm not going to take too long on this slide because presumably if you have shown up for this Byzantine topic, you have some background in ancillary services. But nevertheless, for those that have joined us mistakenly or just out of pure curiosity, this is a chart that we've borrowed from What Clarity. It shows a contingency event happening. What happens if there's a sudden loss of demand or supply, in this case, supply, it can lead to a dip in frequency. And so there are a series of services that are staggered that respond very quickly to this disturbance, bringing the system back into balance. And you can see here there's an initial inertial response, which can happen via rotating machine and the kinetic energy that they contain. And then it can be supplemented by now 1 second, 6 second response, automatic governor control, and then over time, slower responding but larger resources can come into play, bringing that frequency back into the 50 hertz target in the case of Australia. In order to do that, there's two major types of ancillary services that are priced in the market. One is regulation. That plays a slightly different role of automatically having a set point that gets changed over time and largely deals with relatively minor variations from forecast either demand or supply. The main series of ancillary services are contingency. They only get triggered if there is some kind of a contingency event, and they are procured in the market via bids that are provided by resources that also are offered in conjunction with meeting the energy market or the spot market as well. So we have a list here and a summary from AMO, the market operator, if you would like to look at it in your own time. But this chart I'd like to spend a little, or this table I'd like to spend a little bit of time on because when we researched what ancillary services products are being introduced around the world, particularly in Europe and the US, we found that there was actually quite a few of them that may be of interest in Australia in the future. And there are more that we could have put in here, but we wanted to focus on those that were pretty much instantaneous, as well as those are sub-second, because Australia has just introduced the 1 second ancillary services product. And I guess the question is a higher performing or faster ancillary service needed? And if so, maybe it might look something like this. And it'll become more obvious why we think that additional services could be on the agenda for the future because of the changing nature of demand and supply, primarily driven by um, the introduction of intermittent renewable resources on the transition to zero carbon emission system. The other thing I'd point out with this list is that in addition to being very fast response, um, in terms of responding to a detected frequency disturbance, there's also a concept about the ramping rates and ramping margins. And our analysis has identified that this is potentially a significant problem, and one that I'm sure folks on this webinar probably know better than I. So I'll be interested to hear feedback either in the chat or after the fact in terms of is Australia prepared for a system that is 100% renewable or close to it, and the associated dynamic changes in supply, not only in demand, which has been the typical driver of uncertainty. Okay, so let's talk about market fundamentals in the ancillary services market. So let's start with demand, and we're only going to look at the lower markets and only some of them, and then the raise market. You can see here that we have average demand for lower FCAS. That's when there's a disturbance that you actually lower generation, or lower or increase the demand side has the same effect. And you can see here that it has been gradually increasing over time, but not by a huge amount. And you can also see that supply is generally considerably higher than demand, and by quite a bit, much more than say in the main energy market, where it might only be 15% higher at the time of peak demand. Now, I should also say that these are quarterly averages, so not necessarily the same as instantaneous differences in demand and supply. The other thing I'd point out is that while the mix between 660 and 5 minute and reg are similar, you can see that the lower 1 sec, which is the newest product, is dominated much more by battery storage, with a little tiny bit of, I think that's probably hydro there. And the question is, as more batteries are introduced and more of the coal comes out, what's going to replace them? Will we see batteries dominating throughout? Now let's move to the raise market. And you can see here that the average demand, so the level of demand has gone up. If I just flick back and forth, there is more demand for raise. It's a bigger market. There's not as great a difference between the supply side in the raise. It's slightly lower than in the lower. But here you can see something interesting, that not only are you seeing batteries, but you're seeing virtual power plants as well as demand response. So clearly, this is the market that's got more of the new kinds of non-traditional resources, which in the state of the energy market is saying that 53% are now non-traditional providers of this service. So the other thing that I wanted to draw your attention to is, what is the difference between demand and supply? What is basically the reserve margin in the reserve markets? And you can see here that it shows it's relatively flat by hour on an average basis, but that it does seem to shift around depending on what month there is. And there's about a 10% difference between the lowest ratio of supply to demand and the highest one. You can see in the 6 second market, it's significantly lower than in regulation or 6 second, at about 185% of supply versus demand, compared to almost 368% here, et cetera. Now that's going to have an impact on pricing, as we're about to see. So turning to pricing, um, what we would point out here is that there have been some spikes in Q1 of 2020, some spikes in Q2 of 2021 and a little bit of a spike in Q2 of 2022. At least on the raise side. Lower, it's a completely different story. Raise side is generally when there is an outage of a supply source. So in this case, it was loss of South Australia, and then also loss of the interconnectors in 2021. So one of the immediate sort of conclusions I think you can reach is that contingency events play an outsized role in these markets, as they do in the energy market as well. Generally speaking, there's a little bit of a downward trajectory. I mean, the the regulation market went pretty haywire here over 2019 and into 2021, but it's come down a bit. The other thing I'd point out is that the faster response products tend to be more expensive. They tend to be more limited, and yeah, the slower response, the 5 minute and the 60 seconds are lower still. So in terms of looking at any sort of monthly patterns, you see there's a little bit. June and November tend to be a bit higher than the other months. Um, these tend to be the coldest, well, close to the coldest and the hottest months of the year. And then if you look at the rays, significantly lower, and they're almost I want to say the inverse, but you can still see, yeah, the higher prices in February and November compared to, say, June, although you still have November there. So a little bit of a pattern, but nothing too substantial. And again, you can see that the slower products are lower priced compared to the faster 6 second regulation. We did include 1 second because it's just got started. Right. So if you looked on an hourly basis, then, and this is still across 5 years of activity, you can see that prices tend on average to rise in the evening when you've got more of the thermal load, and prices in the rate and the spot market are also higher. But that it gets more diminished as you get to slower products. And then if you turn to the lower again, it's a little bit of an inverse where prices for lowering are more in the middle of the day compared to raising, which are very much in the evening once you have the renewable energy decline, or at least solar, and more of the thermal energy on the margin. All right. So, in trying to understand what is driving those prices, two common drivers of prices would be linkages to the spot market, because, for example, generators that want to offer a raise service have to keep some of their capacity free. They could otherwise bid everything into the spot market, but to bid into the ancillary services market, they've got to make sure they've got spare capacity. So there is an opportunity cost. And so I think it's reasonable to assume that there'd be a relationship of when that regional reference price goes up, that the 6 second price would also go up, because you're taking a risk of not being dispatched, and you could have been dispatched in the spot market. But we didn't see it in the data. The other, and this is there's some relationships here, but another way of looking at key drivers of the FCAS prices was looking at prices versus demand. And generally, and you saw in the average hourly pricing, that uh, you would expect to see, as system demand goes up, there'll be less of a margin left to provide FCAS and maybe less competition. But what we're seeing here is that the price spikes seem to be sort of in the middle of the demand range um, most of the time. And so, again, there's not a really good correlation. So the question remains, what drives FCAS prices? So the other thing we looked at was the demand supply balance. So you remember earlier in the presentation, we showed you different ratios of supply to demand by month. You can see here in regulation, they seem to be grouping around different supply demand points, and this is aligned to the monthly differences. But again, other than sort of notching sort of where they are on the supply demand, there does not seem to be a huge relationship here between excess supply and maybe competition and pricing levels. Similar pattern in the 60 second, and then I think the most interesting is the 6 second. Now this also has the tightest reserve margins on average, and I think maybe if we dug into this and we looked at the extremes or the highest prices of the year, maybe the top 1%, we might see something different. Okay, so the rest of this section reflects work that we've done in the US looking at key drivers of reserves and the potential role that utility scale batteries could play in helping to keep the system in balance. We'll use that then as a springboard for looking at the potential demand for ancillary services over the next 20 years or 30 years to 2050 using AMO's ISP forecast. And then we'll end with a discussion about potential new entry prices. So, taking data from the draft 2024 ISP, we wanted to just focus on dispatchable capacity by type over time. And here we've really just focused on either utility storage or coordinated surge storage. And the reason for that will be evident in the next couple of slides in terms of just how fast and nimble these batteries are. And then we're sort of the other sorts of capacity you can see here is really gas and hydro, with brown coal and black coal being phased out by around 2035. The other thing we wanted to focus on is, which is not including the dispatchable generation, but the intermittent capacity. And here we're grouping together offshore and onshore, as well as utility solar and the rooftop solar, and showing what that looks like over time in the ISP, and comparing that to dispatchable battery capacity. So that's both utility scale and any sort of VPP coordinated storage. And then we also include their fast raise capacity, and I'll get into exactly what that means because it's not the same as generators that can raise or lower and provide frequency control ancillary services, but they are less able to respond quickly in the second and sub-second time scales, other than through inertia. And the reason for that is just how there's inertia in the rotating machine, and trying to get it to ramp up or ramp down quickly is actually very difficult to do. Okay, so let's talk about some work we did with the utility in the U.S. We looked at a potential. We looked at some actual solar output data from the system, and what we found was that you could see rapid changes in output due to cloud cover, and I think we all sort of understand that. But I think what's less clear is exactly how dynamic output can be. And so here must be a cloudy day, and then all of a sudden in minute 57, the clouds go away, and you see that solar capacity go from 10% of nameplate up to 70% of nameplate. And to be able to shift that much, and let's say this is a 500 megawatt, let's say it's a gigawatt, that's just an enormous amount of rate of change that the rest of the system has to accommodate, and would be something that you'd expect the reserves, the FCAS and other kinds of reserves, to be able to manage. And so what we then looked at was, okay, well, as solar gets added to the system, how much additional reserves are they going to need as a function of how much solar? Now, this system has zero wind. It's in a tropical part of the country, and so solar is really the only intermittent resource that's available. And what we found, and there were two interesting parts about this analysis. One was there is a certain amount of volatility in the system, right? There's already unplanned spikes in demand from stochastic events like weather, or maybe there's a TV show that ends and everybody goes and puts the kettle on. That's unlikely in the US, but that happens in places like the UK, or a major TV series ends and everybody gets up and does something else. So in this particular system, we saw that about 100 megawatts of variability was already there. But once the amount of solar in the system got above 100 megawatts, it then became the key driver of of the level of fast ramping reserves were required to keep that system in balance. And it was a pretty even rate. I think since this time, um, the analysis that I would do if we were given the opportunity was to look at how well diversified different solar sources are, and use that so that over time, as more and more of the capacity comes from different parts of the location, that there's probably going to be a leveling off just because things would not be so correlated. And solar PV, rooftop PV is a good example of that. Tends to be spread all over. It's not concentrated in a couple of gigawatts in one place, and so you would expect the ramping to be more diversified than what we're seeing here. So, what we wanted to do for this webinar is to say, okay, well, what other forecasts of FCAS, of ancillary service demand, do we have out there to sort of cross-check on our own analysis? And what we found was, there's hardly any forecasts of ancillary services demand. What we did find was one example in Denmark. They're more known for their wind than solar, and so that might have something to do with their analyses. But you can see here, we included both their generation outlook and their demand outlook. But what we then looked at was they have an hourly max procurement of fast frequency response, which is similar to a 1 or 6 second probably 1 second ancillary services product. So similar to 1 second FCAS in Australia. And they showed the average procurement and then the max hourly procurement. And you can see here that sort of goes up linearly with the solar and wind installations. But then it tapers off at about 2030, and you can see there's no real change in the rate of increase. So there's some other modeling going on. But what's interesting, if you divide it by the amount of solar plus wind, it's a pretty constant level that's falling over time. But it's at a significantly lower rate than what we found here in terms of the amount of ramp to cover this, given an increase. So for us, you basically needed 50% of additional ramping for every 100 megawatts of increase in solar. So a very different outcome here. Not a lot of detail in the report to tell us how they came up with theirs. And then when we looked at the only example we could find in Australia, which was actually done by the IES, or IES for the AEMC, they had significant. They have, if you take the same ratio of ancillary services divided by wind and solar PV capacity, you can see here that they start off relatively high and then it declines over time as a share, which is similar to what you're seeing here, just shown in a different format. But it is 10 times. I don't know, what is that? 8 times higher than what the Danes were saying is what's needed. Now, I should also be clear, though, this is a regulation. So if we went back to the demand graphics, you'll see that regulation is actually the smallest product, and ancillary services are actually double, and in some cases triple that amount of capacity. So if we were to sort of use similar ratios, it would mean that IES's modeling is actually even significantly more in comparable terms than the Danish FFR estimates. Some of the other notable things about IES's analysis is that they do talk about the requirements are influenced by demand, forecasting, and generator nonconformance error. So they don't necessarily speak to solar yet. And they also talk about how plexos can be such a challenge to model this well. And they also put on a 2 gigawatt cap on single greatest contingency and actually what we didn't include in here is for renewable energy zones. I wonder if that's actually going to hold true as these zones get built out. And then finally, they talk about in the future, AEMO's lack of visibility of VPP operations leading to additional regulation procurement. Now, this is not what we found when we did our analysis in Project Edge, but even so, these are all important points about how the system is being planned at the moment. I make some caveats below, but if we take this forward and just with an eye on time here, what we also found in that piece of work we did in the US was just how much faster batteries can change their rate of output than existing traditional sources. And if you look at megawatts per minute as a function of nameplate megawatts, so basically how fast can you change your rate of output as a function of how many megawatts you have. The lithium batteries can go from like 0 to 100 megawatts in like a second. I think it was is the story from the big battery in South Australia. So their rate of change is as fast as it as you could possibly hope for. Whereas if you're a internal combustion engine or a gas turbine, you only get a fraction. So for 1 megawatt, after a minute, you only have like 20% of that. So it actually takes you considerably longer to ramp to where you need to be. And so that's why when you look at the difference between um, a battery capacity and say a coal or a thermal generator's capacity, you can't compare them when it comes to a 1 second FCAS product. And so what we then did was we looked at, all right, well, let's look at the total renewable stack, and let's look at how much battery capacity there is. And then if we applied that PV contingency to just the PV, it's showing that maybe there's not going to be enough batteries if our analysis holds. And I think it's probably a bit aggressive. In Australia, there's a lot of, I think there is a lot of diversity in solar output, even at the utility scale. So it's probably not this bad. But it does raise the question to me, has that analysis been done? I'm sure it has. And are we actually achieving the right level of fast response resources? One of the things that AMO does say, maybe nope, in a different graphic here, that the modeling only really focuses on energy, the energy market, and doesn't really, I think, focus too much on the ancillary services markets. So anyway, I want to leave some time for questions in terms of what that might mean for the future. Here, the analysis we did recently using some AMO inputs was that behind the meter resources are can be very low cost suppliers of dispatchable resource, as can battery storage. And so in over time, if there is a need for more fast response resources, we're probably going to see more behind the meter virtual power plants, as well as utility scale batteries coming into the market to provide those services. All right. So key takeaways. FCAS ensures the secure operation of the NEM by providing a series of interwoven fast response services to keep demand and supply in sync in real time. They're currently driven by interconnector events or other major contingencies, and increasing intermittent solar PV and wind resources, we think, could lead to an increase in the amount of FCAS being procured, particularly fast response, as they become the single largest contingency. It can change the nature of price spikes and the behavior of the FCAS markets from today's approach, which is relatively infrequent, to more common. Overseas market operators are also doing forecasts and linking it to solar renewables. And the ISP may not yet include sufficient battery storage. More work needs to be done. At least more work needs to be done that I'm familiar with. I'm sure it's probably been done. Maybe it's just not been written down. And then finally, for the key recommendations, the pricing dynamics could change. And so people need to be prepared for that to really figure out when this change could occur. You really have to look at the correlations between solar PV and wind resources and re-estimate what that 1 minute curve looks like to figure out when this price effect might take hold. And then there might be additional work needed to ensure that the ramping rates in the NEM are there in order to support the market stability. And finally, didn't add it here, but it could be that we will see additional FCAS products in the sub-second level, as we are seeing overseas. All right, well, thank you very much. Don't forget to vote, and next time we'll be talking about natural gas decommissioning strategies and implications. So please join us for that. It's not in June; it'll be in July. We're doing alternative months, unless you can join us for the U.S. Webinars, which are taking in the intervening months. Okay, let's turn to questions. To what extent? Pardon me, I've got to cough. To what extent can grid forming inverters provide frequency support without a battery providing energy behind them? That's a pretty technical question. I think my understanding of the grid forming inverters is, first of all, you've got the ability to compensate somewhat with power factor. But again, if your issue is not enough energy, I don't think that that's going to have a huge effect on uh, frequency disturbances. But again, I'm an economist, not an engineer. Next question, please. Do you think batteries and SIR will dominate FCAS in the future? Um, I think it's looking pretty good for them, at least with the work we've done to date. And we have done work comparing behind the meter to utility scale, and there are pros and cons in both cases. I think a lot will depend on what's available, and then how well it can be orchestrated if it's behind the meter. All right. What policy levers or regulatory changes would need to be done to achieve the uptake of virtual power plants needed to meet future FCAS needs? Well, I think Australia is actually a little bit ahead of the curve. I mean, in the U.S., we've got FERC Order 2222, which is trying to open the door for more virtual power plant participation in wholesale markets. Um, uh, but I think Australia actually has more registered VPPs in the market, and now they can be registered to 1 second. I know there's at least one battery VPP doing it. I think enabling access to regulation markets can only help. In that is remains the highest price market, and maybe that's because VPPs haven't been able to access it. Next, do you expect other types of customer appliances to participate in FCAS markets? I mean, certainly EVs and vehicle to X are going to be a massive resource that we do expect to be able to participate. I think the question is out around HVAC and water heating. I mean, water heating, to the extent it's a heat pump, there's not a lot of flexibility. Well, sorry, there's a little bit of flexibility in it. There's just not a lot of power behind it. So I'm not sure it will ever be quite as competitive as, say, vehicles or batteries. What will happen to the market if there is insufficient FCAS? Well, if there's insufficient FCAS, ultimately depends how insufficient it is. If it gets tight, we'll see significant price increases, which will attract more supply into the mix, to the point that AMO might actually contract on the side, which they have done in the past, to ensure that there's always going to be sufficient FCAS. And to the extent that gets done, that pulls capacity out of the bid market, which again pushes up price, which encourages FCAS entry. And I think the question will then be, well, if prices are high in FCAS, how fast can those resources be built? We know that large-scale batteries can be built really quickly. We saw it with the big battery in South Australia. Next question, please. I'll take a couple more. We'll go a little bit over. Apologies for those that had to leave. Is the current payback for batteries being driven predominantly by ancillary services rather than energy shifting? And when will there be so many batteries that the market cannibalizes itself? So I think that's the billion-dollar question. My understanding is that ancillary services up until the last couple of years have been a key contributor to ROIs. And when we've done analysis of value stacking and where you put your capacity, ancillary services markets have gotten the lion's share. Um, that being said, they are a very small market. You saw the size on them; they're like less than 1% of the rest of the market, so um, they are easily swamped. However, having said that, the the contingency event and the ability to get online and to add supply to the market in the short term is very constrained. So while they are very small and they shouldn't see persistent high prices, we saw that over 2019 and 2021, but they have come into a lot better balance now. Question is, when are they going to get out of balance? And I would say that is, you just got to look at how much solar and wind's coming online, and particularly solar. I'm less familiar at how dynamic wind is. Batteries versus synchrons. This is the battle of the ages. To support network, when do synchrons run out of puff and will any more be installed as now batteries are a better solution? I mean, synchrons, to my understanding, are really kinetic energy sources. Synchronous yeah, they're spinning rotating machines, very well understood technology, but there's only so much you can store in a giant flywheel. And as the battery costs come down and battery prices have halved over the last 12 months, at least at the lithium cell level, it's going to be harder and harder to compete, I think. And I think there may be some regulations. I remember looking in South Australia, for example, on requirements for new connections for solar had to include some kind of synchronous condenser on them. I'm sure they've changed by now, but it just speaks to the risks of requiring certain technologies given the rate of change of technology. Do you think AMO might introduce a mechanism or requirement for home batteries to participate in FCAS? Well, so that's another interesting point. And I've had not heated, but spirited discussions with utilities around the notion of whether behind the meter batteries are giving a free kick to everyone else because of standards like AS 4777, which require certain responses if frequency goes too high or too low. But my understanding from these discussions is that the utility scale batteries also have to provide similar services for free. So I think there's already a for free element. And to be honest, I'm not clear as to why we have ancillary services if we have this, volt var, volt watt sort of standard built into these inverters. They should be handling all this for free. So maybe somebody can enlighten me. Forecasters are assuming FCAS revenues decrease dramatically. So if arbitrage is to be the source of revenue, that ought to mean higher electricity prices as battery investors will need to get paid. No. Um, well, I haven't seen these forecasts, but I think everybody. I mean, to me, it's sort of like Sydney housing prices, right? They can't go up forever. And yet, if you didn't buy a house in Sydney in 2003, like me, because I was waiting for it to come down, we're sort of out of luck at this point. And so I think the key thing for the FCAS revenues is just how much and how quickly solar comes on compared to how fast storage comes on. That's fundamentally the message I want to leave everybody with. Based on that analysis, solar, particularly if it's concentrated in a particular renewable energy zone, is we're expecting it to lead to significant pressure on FCAS prices because of the additional FCAS that will be required and not able to be provided by anything other than batteries. Just because of the rate of change, it's just not competitive for any other source to provide that. Well, we're a little bit over time, but we'll give it if people are still got questions. But now's the chance. All right. Well, I think that's it. Thanks again for spending some time with us. Hope you enjoyed it. Please, we will send an email tomorrow that has links to the presentation, links to a blog. Please send it on to anybody you think might be interested. And I look forward to seeing you at our next event in July.